In this lesson, we're going to learn all about audit evidence. Audit evidence is the stuff we gather as auditors to support our opinion on the fairness of presentation of the financial information prepared by management. Audit evidence must be documented. Audit evidence must support risks at the assertion level. You remember what we talked about in our last lesson about existence and completeness and accuracy, etc.? In fact, this is where we're going to start our story, and that is by determining which risks could result in a risk of material misstatement at the assertion level. We are able to do this because as auditors, we know the business and the industry. We can do more than just tick and bop. We can identify balances with high-risk assertions for whatever reason, and then focus audit work on that area. Perhaps it's the valuation of an intangible asset, or the measurement of sales that involve multiple deliverables. Having identified those key risk assertions, we design a procedure to gather evidence that addresses the risk associated with that assertion. In the case of a valuation of an intangible asset, we will need to inspect the future cash flows of analysis and compare the assumptions to our own expectations. In the case of multiple deliverables, we will need to gather evidence to support the fair value of each component and determine whether the company offers each component separately or as part of a bundle. These are complex examples, but intended to illustrate how the procedures are tailored to address specific risks. An audit procedure is basically an instruction for an auditor to perform to gather evidence. However, designing a procedure in and of itself is not enough. We also need to consider the sample size because we are unlikely to look at all the evidence available. We also need to look at the sample selection method to ensure our approach is statistically valid. For example, in certain cases, a random sample may be preferable over a judgmentally selected sample, and vice versa. And we consider the timing of when to perform these procedures. For the income statement accounts, we are concerned about the activity that happens throughout the year, so we should sample and test throughout the year. For the balance sheet accounts, we are more concerned with the balance as at the year-end date, and would try to perform as many of our audit procedures as close to that date as possible. An audit program is a list of those audit procedures that we intend to perform for a particular area. Audit programs are often computerized and can be easily tailored based on the risk assessments. And by tailored, I mean we would plan on doing more extensive procedures on areas with higher risk. Now we have a foundation upon which we can discuss the persuasiveness of evidence. GAS requires the auditor to obtain sufficient appropriate audit evidence to support their opinion on the financial statements. Let's take a moment to better understand what this really means. Sufficiency speaks to the quantity of audit evidence gathered, and in general terms, the more evidence gathered, the more persuasive it should be, which only makes sense. However, sample sizes are also impacted by the effectiveness of the internal control system. If we test the system of controls and convince ourselves that the internal controls are effective, our sample sizes can be reduced because we are in essence relying in part on the client's controls for part of our warm fuzzy feeling. Note we have two types of evidence here. Test of controls is evidence that supports the control system works and indirectly supports the achievement of the management assertion. Substantive test results are evidence directly supporting the management assertion. Appropriateness speaks to the quality of audit evidence. That is the evidence gathered relevant and reliable? The higher the quality of evidence gathered, the less of it you need before you are persuaded that the item of interest has been fairly presented. Relevance is achieved by gathering evidence that specifically and directly addresses the assertion of interest. Reliability is enhanced as we gather evidence that has been independently generated separately from the client. So, for instance, the strongest type of evidence comes from the auditor's direct knowledge. Perhaps we saw it with our own eyes in the case of an inventory account. The next strongest source of evidence would come from a provider independent of the client, say a confirmation of the cash balance by the bank itself. When the client provides us with evidence, we need to consider the strength of their internal control system. The stronger it is, the more persuasive the evidence. We should also consider the qualifications of the individual providing the evidence. Those with expertise are far more persuasive than those who provide evidence without qualifications. Consider evidence from specialists or lawyers as being more persuasive than perhaps evidence received from a customer. Objectivity is important, as we would prefer evidence that is definitive over evidence that requires judgment to interpret. So, for instance, consider the subjectivity inherent in a legal position for a lawsuit. And lastly, sometimes multiple pieces of evidence are required to corroborate an assertion. If all the evidence is pointing in the same direction, that too is more persuasive. Gathering evidence comes with a cost, so there is continually a trade-off between the cost to obtain evidence and obtaining the most persuasive evidence possible. There's a tremendous amount of pressure on auditors and clients alike to be as efficient as possible in conducting and containing the cost of the audit. Now let's talk about the ways in which the auditors gather evidence. So far in this course, I've been using nebulous terms like verify to describe my audit procedures. This is actually a horrible descriptor, as it really doesn't say how or what exactly the auditor is to do. Similar sorts of bad language would include check, review, obtain, audit. Let's look at better ways to describe and perform our evidence gathering activity. GAS talks about inspection, observation, inquiry, confirmation, recalculation, reperformance, and analytical procedures. I'll briefly provide a description and the quality of evidence provided by each of these sorts of procedures. First, we have inspection. An inspection is the physical examination of the item of interest. You can inspect the condition of a piece of equipment by looking at it yourself. You can also inspect a document that supports an amount paid by the company. Inspection is a wonderful way at getting at the existence assertion, but note that it may do nothing to cover off the rights and obligation. So you get the idea. A couple of more points when it comes to inspection and evidence. First, keep in mind that internal documents are less reliable than external documents. Also note, there is a concept of direction of testing, which is important for you to understand. The so-called audit trail is the trail of evidence that exists in either paper or electronic form to process a transaction. For example, a sales transaction is initiated by a sales order, which might be mailed, faxed, or electronically submitted through the internet. Typically, this triggers a shipping document, which is used by the warehouse to pick an order. It gets dropped onto a truck, which creates a bill of lading, indicating that the order has been shipped. This typically triggers an invoice to bill the customer and set up a receivable and record the sale in the general ledger. This is an example of an audit trail. Now, if our audit objective is to verify the existence assertion, we would need to start at the general ledger and work our way back to the source documents. That is, the sales invoice, then the bill of lading, and then the shipping document, and finally the sales order. This is called vouching a transaction. However, if our audit objective is to verify the completeness assertion, we would start with the source documents and work our way to the general ledger to ensure that all shipments have in fact been booked as revenue. And this is called tracing. But between you and me, I never can keep the terminology straight. But it's critically important that you understand this notion of direction of testing because it's important for your inspection procedures. Let's look at another method of gathering evidence now. Observation can be used to gather evidence by seeing it for ourselves. We may want to observe the client performing certain control procedures as a test of controls. Observation, like inspection, has limitations because what we may observe may not happen all the time. Inquiry is another type of evidence gathering procedure, and it happens when we obtain written or oral representations from the client. This is extremely easy and cost-effective evidence to obtain, but is rarely sufficient in and of itself. Confirmation, on the other hand, happens when we obtain written and oral representations from independent third parties. These parties verify the accuracy of the information in management's records. This is much stronger evidence, but it also requires strict controls by the auditor to ensure that the client does not interfere with the confirmation process. It is also more costly to obtain confirmation evidence. Positive confirmations, are the most common form of confirmation. We will confirm such things as the balance in the bank account, loans outstanding, and amounts owed from customers and amounts due to suppliers. Positive confirmations must be followed up and a response obtained. As a new auditor, you may find yourself spending considerable time calling various parties trying to solicit a response to your confirmation request, and you may have to promise your firstborn child to get a reply. Negative confirmations are easier to administer but provide less persuasive evidence. A negative confirmation is sent and the respondent is only asked to reply if the amount is wrong. No follow-up is required. Another procedure is recalculation, and it involves rechecking the computations performed by the client to ensure arithmetical accuracy, which is obviously important, but does not address the assertions of existence, completeness, rights and obligations, etc. Computer-assisted audit techniques, or CATs for short, can be used to help recalculate huge quantities of data. Audit software that you may come across include ACL and IDEA. And basically it works by importing to your laptop such data as the inventory file, the receivables file, the general ledger itself. And once the data is imported, you can do all sorts of recalculation tests, such as testing the inventory extensions or the aging of the receivables to compare against the client's records. Our next audit gathering technique is called Reaperformance, and Reaperformance is often used to test controls. Here the auditor reperforms the internal control procedure to determine if the client has done it correctly and effectively. And once again, an auditor may use a computer to help out. A CAT can be used to test those electronic internal controls that are baked into the client's IT systems. And this can be a very efficient way to audit a client who has a strong IT system, as once you prove that the IT system is working effectively, you need not prove it over and over again unless there's a change to the code. One example is to use dummy data and have the system process it to see what happens. If it is processed correctly, you've got a system you can rely on, and this saves you the need for doing a whole bunch of manual recalculation procedures. And finally, we have analytical procedures. And those are the procedures that compare the current results against the expectation to determine whether the results appear reasonable or plausible. And if you think it sounds a little bit wishy-washy, you would be right. But that's only because analytical procedures encompass a very broad spectrum of analysis that can be performed, and they rarely stand as audit evidence alone. The key is to determine what a reasonable expectation is, and there are many ways to go about this. Some are simple, for instance, comparing a result against a prior year or a client-prepared budget if realistic. However, it can get much more complex as you get into ratio analysis, industry analysis, regression analysis, or other statistical techniques that can be used to determine a plausible basis for establishing an expectation. Some of these more sophisticated analytical procedures can provide you with a very high confidence level over your findings. So it's not wishy-washy at all. You should be well versed in financial statements and ratio analysis to effectively use analytical review as an audit technique. For a refresher on ratio analysis, you can take the financial literacy course at the financelearningacademy.com to learn more. Having defined the expectation, you are now able to drill into the actual results that are different or unexplained or unusual. Analytical procedures are so important that they're used throughout all phases of the audit. During the planning phase, analytical procedures help us to identify areas to focus. Analytical procedures can also be used to assess an entity's ability to continue as a going concern, which means that the entity has sufficient liquidity to meet its obligations as they come due. This is an extremely important assessment because if an entity fails this evaluation, then it casts an entirely different light on the financial statements and requires all sorts of incremental reporting considerations for the client. During the execution phase, analytical procedures are an important piece of audit evidence. In fact, often an analytical procedure can be a very effective form of evidence that would alleviate or reduce the need for detailed audit testing. For example, interest expense can often be estimated by taking the loan balance outstanding and the interest rate. If this estimate of interest expense is very close to what has been reported by the client, then further procedures may not be necessary. And during the completion and the reporting phase, analytical procedures enable a partner or a senior manager to make an overall assessment of the financial statements and allow for one final assessment of whether the audit file sufficiently addresses the areas of possible misstatement. There are two areas that we want to spend more time on. And the first one we've already identified, and that is the area of material risk. The high-risk material areas require us to gather substantive evidence to support management's assertions. The second area of particular interest to auditors is the financial statement closing process. And this is where the senior accounting people often make journal entries directly to the general ledger for any number of reasons. Many are driven by GAAP or perhaps a system limitation. And thus the auditors will spend time agreeing the journal entries to supporting documentation and ensuring that the financial statements are reconciled to the general ledger and subsidiary ledgers. So there you have a fairly robust discussion of audit evidence. Auditing is as much an art as it is a science sometimes, and as you gain more experience, you will begin to develop spidey senses of whether you have enough evidence or not to feel confident in the numbers management is representing. This concept of audit evidence will recur throughout the balance of the course, so bear in mind that not all evidence is created equal. Until next time, don't stop till you get to the top. When you get to the top, don't stop.